Good morning, good evening, good afternoon, good night, depending on where you are on the world and at what time you're watching this show. This is my review of what happened in 2020. I hope you had a very enjoyable Christmas and maybe still enjoying your holiday season. And I wish you already a very happy new year and that things may be a lot better than they were in 2020. What I'm going to do in this show is walk you through the most important rotations that we saw on an asset class level and the most important sector rotations, and try to see what we could learn from them and whether it helps us going into the new year of 2021. I would like to start this review of 2020 for sectors and sector rotation actually one level higher at an asset class level, just to get a feel of the bigger picture. And what we have on the left hand side is the perf chart for the asset classes that I usually track in Sector Spotlight. What we see is that actually stocks were the best performing asset class in 2020, 17.5%. The second one is our balanced index fund, so that is our benchmark. And then we have corporate bonds up a little over 10%. We have treasuries, corporate bonds, up almost 8%. And then there's one more that has a positive return, that was high yields, and all the others were in absolute terms giving us negative returns. It's the US dollar, it's real estate, and it's both commodity indexes, with the Bloomberg Commodity Index down 8.75%, and the S&P GSCI almost 27% down. That's the one that has a lot of energy in it. So stocks once again had a great year if you just look at the end of year figures. But how did we get there? What I want to do next is walk you through what happened in 2020 with stocks, and we're going to use the S&P for that. And the chart here on the right shows you the position and the trends that were in play at the start of 2020. So this one is now dated on the 3rd of January 2020. And we can just walk through the year, and when we start the year, everything seems fine, no problem at all. A few bad weeks, then we tick up again, and then we hit the 14th, 21st of February. Those were important weeks, because that was until then the high of the year. And then the news broke about the pandemic and COVID hitting, the world round, and stocks got a pretty serious beating in a few weeks. So we're here, and now we're moving into March, and this was the week of 27th of March. This is 27th of March when we hit rock bottom. So in a matter of 4 or 5 weeks, the market loses 35%, which is, as you know, pretty serious, and outlook was pretty grim at that time, and nobody thought it could recover. But markets once again proved to be very flexible, very adaptive, and very forward-looking, because from this moment onward, the market starts to pick up, and we basically go up with we make our nice series of, this is a weekly chart, so we got nice weekly high-low rotations, and in the middle of the year, we have a few weeks where we don't make a new high. So this one here, let me make the cursor there. So this was June, and now we are here in July. So that's about a month, 6 weeks that, we moved sideways, and then we started to move higher again. And we actually start to challenge the old high. So we're now back. So now we are in August, and we're back at where we're actually above where we started the year, but we're back at the high of the year, which was pretty stellar. I don't think a lot of people would have expected that somewhere in March, so to say. Now we break that high, which was, a super strong signal, and drop back. This was when people started to worry again, but as you can see, we had this old high picking up this level here as support. We start to move higher. Do it again, and now we're actually very recently, because it is now it's now mid-December when I record this, and you actually move higher, and we are now at 36.60, so to say. So we're trading very close to all-time highs. We actually just broke it last week. So that trend is still intact, and that is how we got to that 17% return, 17.5% return that we saw for the stock market in 2020 so far. Of course, there's still 2 weeks to go, but things are looking pretty good for now. In this macro type thing, how did that work out on the RRG? We're not going to go over all these individual sectors. The only thing that what I've learned, because reviews you always do to learn something from what has happened. And if you look at the RRG, then this is the start of the year, at start of January, and you see that stocks were inside the leading quadrant and still moving right. And then it started to roll over a little bit, and here we are at the high. We saw stocks move, lost a little bit of relative strength there, but nothing really major. And then there comes this very fast and swift decline, and when we hit rock bottom here, stocks move into the lagging quadrant on the RRG, and government bonds move upright. Clearly that was a late signal, because we've already had that massive decline, and the market started to move higher, and we started to pick up, and the RRGs adapted themselves pretty quickly, and they picked up again and put stocks back into the leading quadrant. But you can argue about it. It was late. Of course it was late. It's a trend following algorithm. We're trying to find trends, and what I've learned is that when you have these very, very fast and swift moves, those are just too fast for the weeklies to actually pick up in a timely fashion. So for the last second half, we were still doing very good. Stocks continue to move on the right, where bonds continue to move on the left, so still a preference for stocks over bonds, and that is actually still the case. Now, if we quickly go back and we make this a daily RRG, then you can see the difference and how much faster it actually picks up those changes in rotation. So it's a good example of the difference between the daily and the weekly RRG. Let me highlight that stock tail here. So here we are, and let's move to the high. So we're here, and then it, stocks just went back into the leading quadrant, and we rolled over, and here we are on February 26, and we move into the lagging quadrant, which is only shortly into that big decline. We pick that all up all the way down. Stocks remain in the lagging quadrant, and there we start moving back up, and here we're already improving. We're now April 2nd, and we can make that all the way here, and now we go into leading, and we start to pick up momentum again, and that's in April. And now we stay most of the time, not always, there's a few times when we move back to the left, but the general rotation for stocks is on the right hand side of the chart, and to the right of government bonds, of GOVT. So keeping us on the right hand side of that trend. Here we go. This is the week stint that we had somewhere August, September, October, that sort of flat spot in VBINX. We do it again. Once again, and here we're picking up again. We're now still on the right hand side, inside leading, just returned to weakening mid-December. We'll have to see how that works out, but it's still in favor of stocks over bonds. Now, from this macro perspective, there are actually two charts that I wanted to highlight for this review. And the first one is the comparison of stocks versus bonds directly. That we saw that on the RRG, and here you see the longer term picture. This is a monthly chart, and I've written about it, and what I think is was very similar is the situation that we saw in, let's say, 2013, 14, 15, 16, where we reached new highs, and then for like 1, 2, 3 years did nothing, and at the end of 2016, after the presidential elections, we broke higher and we actually rallied. We saw a big increase in the SPY IEF ratio, and we had a similar situation because after this almost 2-year rally, that ratio stalled, actually had 2 serious dips, and didn't go beyond that 2018 high until after the presidential elections of this year, of 2020. And we're now, I would say, pretty comfortably above that resistance level. Going into the new year, we're looking at a situation similar to the end of 2016, which suggests that a further outperformance of SPY over IEF, stocks over bonds, is on the way. Now, one extra chart that I want to share with you on asset class macro level is the one that is the overlay of the 10 2-year yield curve with the S&P 500. And I've used this chart a few times in my articles and in Sector Spotlight, and I continue to track this because this is long-term stuff. This doesn't change like overnight. But what I see here is that the acceleration of that steepening of the yield curve, it seems to be accelerating. It's a pretty steep line, and it looks as if we're in these moves that we saw here in the past. And I'm very curious to see how that plays out once we start 2021, and whether that is a good thing or whether we need more of a decline. It is the one thing of all these macro things. You know, this is all good. Stock trend is all good. This is the thing that puts a question mark on top of my head. Whether the let's say the Corona dip in March was the dip that you usually see when the yield curve starts to steepen and comes from an inversion and steepening, or do we need a little bit more? For now, the charts and the sector rotation are not signaling anything like that, but this chart makes me keep an open mind to the possibility of a bigger correction in the stock market. But again, we don't see anything like that yet. This is the little flashing light in the back of my head. Now let's dive into the breakdown of that 17.5% return of stocks, depending on whether you look at SPY or ITOT or dollar SPX. But let's have a look at how that return for 2020 was composed and how it came together in terms of sectors and sector rotation. On the perf chart, you see the year-to-date returns of all 11 sectors. And well, what I immediately note is the huge difference between the biggest winner and the biggest loser. The biggest loser is energy with a negative of almost 28%, while technology is up 37%. That is a 37 plus 40 plus 30 is 70. That's 65% difference between the two. And just to put that into perspective, if you would have bought technology at the start of the year and shorted energy, you would have made 65%, which is, you know, great. Of course, it's virtually impossible to time it that sharply. But if you just write a little bit on those sectors, you can add to the bottom line of your portfolio. Now, what I would like to do is not go through all of those rotations because that would be too much, but just pick the most important rotations on the positive side, but also on the negative side. And of course, we're going to use an RRG for that. And if we just have, the cool thing is that it is 1 year look back. And if I have 1 year look back, if I animate that chart, it gives me exactly 1 year from now, because this starts at the first week of January 2020. And if we play it, then we see that rotation and those big moves taking place. Energy flying off the chart and technology staying on the right-hand side of the chart. Now, let's start with the negative. Let's start with energy and highlight energy on the RRG and bring up a chart of energy here and position that at the start of 2020. So we're here, this is 26th of December, and here you see the tail of energy at that time, December 7, 2020, so now I should put it here. So now we see energy matching the position here. It's inside improving, moving to the left, moving to the right, improving, but still at very low RS ratio levels. If you look at the animation, you will see that energy was on the left-hand side, on the negative side of the RRG graph all the time. Even now, with this huge tail going up, it's still the weakest sector in terms of RS ratio. Now, if we look at the moves of that sector through the year, then we see there was actually, look at this dipped here. That is, when you break support, what that means, both in price and in relative. And you got a massive rise. I mean, this is a more than 100% rise. Depends a little bit on your time frame whether you were able to catch that. The RRG, the weekly RRG, for sure didn't catch it because we're still on the left-hand side, and that relative, because RRG is all about relative, wasn't very strong. That didn't do much. Price performance, fantastic. We pick that up if you're trading that time frame. All the better. But from a relative perspective, it still didn't work, and we went down again. Come to test, put in a higher low. That's good. And we're coming from low levels in the relative strength, and we're now here. So that bottom, both in price and in relative, is still not there. The swings are good. The tail is still very far to the left and picking up a lot of momentum. We'll have to see how that pans out, but that was one very big rotation in 2020 that we need to be aware of. Now, flipping to the other side, to technology, if we bring technology up on the RRG and we switch this chart here to the technology chart, and then we put that one back to the start of the year. So that is November. Let's see, the 3rd of January. Here you go. Now let's play that animation for technology. So we start in the green, we move, we stay there. So let me pause that for a minute. You see that it's rotating, just stay there with that very short tail. That is just the characteristics of a very strong uptrend. We just stay there on the right hand side, move a little bit higher, maybe a little bit lower. That's all good, that's all strength. And then we go a little bit weaker, and now we turn, well, maybe up. Not sure what's going to happen there. Now let's see what that looks on the price chart in combination with relative strength. If we start that year, that relative line had just pushed to new highs. The RRG lines had bottomed out and came from weakening back into leading, which is, as we know, usually a pretty strong sign. And that's how we started 2020 in the technology sector. We move higher, and then we got that big dip into March. And this is, I want you to look at this, because we see this big dip here, and it's a big price dip. There's no doubt about it. But compare this dip to other dips in other sectors, and especially from a relative strength perspective. Because if you look at the relative, despite that massive drop in price, that relative didn't do much. That just stayed strong. And that's the characteristic of relative strength. That's why relative strength is so important. It keeps you on the right side of the leading sectors, even if they all go down. You're in the one that goes down the least, or not at all. And what it also means here in terms of that technology sector is that we're actually picking up very rapidly, and we're clearing back to new highs here. Where is that? That is now June, and very decisively in July. So July, we're back above the highs. Many other sectors didn't make it back to the highs that we saw earlier in the year. So that's another sign of relative strength for technology in 2020, when it was one of the first sectors to take out its highs that were set before the March drop. And we see that continuing actually in relative strength a little bit more, and then we start to fall over and roll down. So we have that high here in the summer. This is actually August, 31st of August, and then from there onwards, you see that technology was not able to push to new highs, and here we are mid-December, still trying to push to new highs for that sector, and that has taken its toll so far on relative strength. Relative strength has peaked somewhere in August together with that peak in price, and has now started to move sideways, and that is causing the RS ratio line to move lower following the RS momentum line, which has already dipped below 100, causing the tail of XLK to be inside the weakening quadrant. So, this is not a outlook, but we do need relative strength to move higher and price to break out for technology to come back into fashion going into 21. Now let's move back to the right-hand side of the graph again, and we'll pick up financials and their rotation. So if we pick up financials here, then at the beginning of the year, they had just rolled over inside the leading quadrant. So let me bring up financials here and position that start of the year. So this is the 9th of December. Here we are, start of January. We see that the relative strength it's trying to bottom out. During 2019, it has moved sideways, and we're doing our best. We had this break to new highs going into 2020, and we see that at the end of December it started to roll over, and that's where we start the animation for the XLF tail on the RRG, and we actually move through weakening into lagging and stay there. So it was one of the weaker sectors going into the decline, and it stayed there when the market started to recover. Picked up a little bit of momentum, but not much, into improving. And here you see it's still the second, third weakest sector in the universe. And we roll down again, pick up a little bit unclear, and now we pick it up again, and we are just moving into the leading quadrant. So we're picking up momentum here. Now let's see how that looks on that price chart. And you see that decline going in. You see, we talked about breaking support in relative strength. I think it is meaningful. I think a break of support or resistance in relative strength can give you a very good clue about what's ahead of you. And we actually see that moving further, and then it's picking up. You see the market's rallying, but that relative strength is not doing very much. It just stays there, moves a little bit lower. And, because it moves sideways, the RS ratio is coming up. There's a little bit of positive momentum, and that is where we are right now. So we're now, it looks as if we're now trying to bottom out in terms of relative strength. The momentum has already picked up a little bit, and it's now dragging RS ratio back above. This is one sector that has not been able to break to new highs. It's not above its 2020 high yet. It's one of the few, actually. Now, we go back to the plus side. There is consumer discretionary, XLY. So if we move to XLY and position XLY at start of the year, and now we have XLY here on the chart. And we put that at the start of the year. So, here you go. 26th of December, 27. So just broke to new highs in terms of price. And you see that the tail is picking up. It's improving. And it rapidly moves into the improving quadrant. It hesitates a little bit, tail gets shorter, and then we move over to the leading quadrant somewhere in May. Now look at that. Here's the relative that broke down, started to flatten out. And we just need a little bit of time to actually, make our way back up. And you see that RS momentum is picking up here, starting to drag up RS ratio. One more dip, and then the whole world realizes that everybody is shopping online and has Amazon deliveries, and there we go. Market moves higher, not as fast to new highs as technology, but shortly thereafter. And we move to that high over there, and then we do it again, and now we are here very close to all-time highs, but we're rolling over in terms of relative strength, and that's what you see here as well in the tail, where we had that very long stint through leading, and now we're moving through weakening, heading towards lagging, but still very comfortably above 100 on the RS ratio line. So at least a temporary dip in relative strength for discretionary. Now I'm going to stay on the left-hand side because I want to cover one more sector with you, and that is the communication services sector, XLC. And if we look at XLC and push that one back to the start of the year, and it was at a short tail moving into the improving quadrant. And if we put this chart here at the start of 2020, this 9th of December, let's see how that played out at the start of the year. Let's look at the tail here. Let's animate it. It's got a short tail. It's got big weights of Google there, so it usually doesn't move away too much from the center of the chart. But you saw the improvement at the start, and from pretty much March onwards, it remained on the right-hand side. Went through a deterioration from August onward, which put it into lagging for just 1 to 3 weeks. Now it's pushing back into the leading quadrant. And that is what we see here on that price chart as well. You see that relative strength moved sideways. Now it's breaking out to the upside. That's when that move into the leading quadrant is happening. And then it doesn't do much for the next few months. And you see that those RRG lines are dropping again. And it looks like a new range on top of that range. And we're now breaking to new highs at a very late level, breaking to new highs again. We saw technology didn't do that yet. Discretionary did do it, and communication services. So that makes it one of the stronger sectors as we're leaving 2020, just breaking to new highs, and it looks as if we're going to get a break to new highs in relative strength soon, and that will push communication services potentially further into the leading quadrant. So that's the reason why I wanted to finish this show with communication services, because as we are recording it now, this seems to be one of the leading sectors together with financial that has just broken into the leading quadrant. And so I want to leave it at that. That was the review from asset class level and the most important sector rotations that we saw, combining the RRG chart with the price chart and working our way through those various rotations, bigger and smaller. It's always a good way to actually learn about what happened and look back and try to see if we can learn from our mistakes and learn from what the market has taught us in 2020. Thank you for watching. If you have any thoughts that you would share with us, please use the comments below. For now, I want to wish you a very happy new year, and I'm looking forward to catch up with you in 2021.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.